You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
All right, everybody. That music means it is time once again for Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and sometimes beyond and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo from the aforementioned network as well as, of course, from theoptionsinsider.com. Glad you guys are enjoying the slew of content we have heading out at you these days. We know pretty much all of you stuck at home, and also most of you worrying about these markets. So we're trying to get as much content out to you as humanly possible. Glad you guys are enjoying it. If you like what you hear, continue to leave those reviews and those comments on those platforms wherever you find it so the new folks can continue to discover this fine network. We've been doing it for a while now, 13 plus years, but it's always nice to see the new folks flocking in, especially at times like these when people could use some of this content. So keep those comments, those reviews, and of course your questions coming. We do love to hear from you guys. And joining me on the old program today, I am very pleased to say that I am joined by two of our kind of original network stalwarts. They were there not quite at the beginning, but not that far after over there. And they certainly were there at the beginning, at the very dawn of, the gestation of one of our flagship programs these days, which is Volatility Views. Yes, I'm talking about the original Volatility Squad. I'm joined once again by my old friends, two of my favorite people, Mr. Bob KRAUSE and Mr. Don SCHLESINGER, now from Demand Derivatives. Gentlemen, welcome back to the Options Insider Radio Network. It has been far, far too long.
Thank you very much, Mark. This is Don here, and it's really a pleasure to be back. Some very fond memories of the great shows we did, probably 100 or so on Volatility Views, and we're back with continuation, if you will, and an expansion of that product, that entire process and that company. So we will look forward to chatting with you and letting you know a little bit more about it.
Don, it seems like just yesterday you and I were sitting down by the croquet courts in Boca, sunny Boca, talking volatility. It's hard to believe it's been over half a decade, sir.
What's hard for me to believe is that we finally parted ways after about 100 shows or so, and I just saw the mention of your 400th Volatility View show. So that's an incredibly long run, and congratulations on all that you did after I left. It was really terrific.
Yes, that show has been the little engine, well, not quite so little anymore, the big engine that could, but yeah, it's become one of our flagship programs, as you mentioned, episode 400 coming up this Friday. Hard to believe that is indeed the case. A lot of testimonials pouring in from folks all over for that show, so that's going to be kind of fun this Friday. Stay tuned for that in a little bit. But, you guys haven't been on Volatility Views and on the network in quite some time. It doesn't mean you've been sitting idle, just pining away for the good old days on Volatility Views. I know you guys have been working diligently behind the scenes to keep the vol products and indeed a whole new suite of offerings alive. So, Bob, maybe catch us up. I know you've been cranking away behind the scenes to keep all that movement alive. Catch us up. It's been a while. And then, what the heck is demand derivatives, sir?
Hey, thanks, Mark. Yeah, it's been a long time, and I really appreciate you asking us back. And hi to all the listeners. Hopefully you remember us from 300 shows ago. I don't know. Hopefully you were there since then. Anyhow, excuse me. Demand Derivatives is the parent company of a new futures exchange and clearinghouse. So we've really expanded our project. When we were on Volatility Views, we were trying to get one instrument up, a realized volatility, futures contract. And we ran into several roadblocks there, which, we kind of, more than hinted at, but, hinted at during the show. So anybody that has been around that long may remember. But what we decided to do was not just abandon it. We thought that was a great idea, but then we started coming up with new ideas, and we now have a suite of 4 different instrument types. So just to kind of get anybody caught up who hasn't been around, so a standard futures contract, a standard futures exchange has essentially 2 contracts, a futures contract and an options contract. And we decided to reinvent the instrument itself. And so we have 4 new instrument designs that we're going to place on 6 key assets to start. And those key assets are the majors, the largest asset in each asset class. So, in metals, that would be gold. In ags, that would be corn. Crude oil and energy, the 10-year for rates, S&P or something similar to that for equity index, and what am I missing? FX, and then the euro and FX. So on a asset by asset basis, I guess we'd be competing, with existing exchanges on those assets. But on an instrument by instrument basis, we have no competitors because these are brand new. We filed for patents on the process, and we're going to try and launch these things. Now, starting an exchange is not that hard. I mean, it's not easy, but it's not that hard. There are something like 400 crypto exchanges now. Where it gets difficult is in clearing. And so we had to figure out how we were going to clear. And, maybe we go with our hat in our hand to the CME or ICE or OCC or somebody like that to clear the products. But our innovations were such that we could save, we felt, about 90% of the clearing cost. And with such huge savings, we've tried to figure out how we could do it ourselves. And so we solved that puzzle, and so we're going to open up our own clearinghouse. Now, for a lot of people who are, familiar with clearinghouses, that's like crazy. I don't care if you're Mike Bloomberg and you had $1 billion to throw into it. You really couldn't start a clearinghouse these days, for $1 billion. It's just practically impossible. But where we came through with the breakthrough is with a limited risk product. So one of our 4 instrument designs is called Real Limit, and I'll let Don explain that a little bit more. But basically, we limited the risk to the posted collateral, and because we did that, then we have all of the collateral. If we're limiting the risk to the amount of money that you put up, then this instrument or this risk is fully collateralized. If it's fully collateralized, then many interesting consequences come from that. You don't need a guarantor, which is essentially your broker. They act as a guarantor in case you blow through your margin and can't pay or whatever. As far as the clearinghouse goes, there's a guarantee fund that the clearinghouse has, as a backstop in case everything goes wrong. They have credit facilities. They have a risk modeling group to try and figure out what is the correct margin. And then obviously, like all these clearing members, and they kind of have to do audits on their clearing member almost every day to make sure that they have enough collateral and capital to survive a downturn or whatever. And when you get right down to it, if we have all of the risk capital and it's sitting there in the bank, that's it. There's no more risk control that needs to be done. Everything that could be lost is covered. So there's no credit in our system, no default risk in our system, and that's the way we were able to launch a clearinghouse very simply.
Look at you there, Bob. You've graduated to the next level now. When you were on the network in the past, of course, and a lot of new listeners have joined since then, you were, at the time, you pretty much focused on this realized volatility instrument, which, of course, unlike what's out there like VIX and others, which attempt to give you, I should say, really, the implied volatility in the marketplace, you had an instrument that was attempting to capture the realized, the historical volatility in the marketplace out there right now. And, of course, through the challenges of listing a new product, which we all know are legion these days, you've since retooled it and reworked it, and now are not just launching a new product, but effectively, as you mentioned, a new exchange and indeed a new clearinghouse. So you've upped your game considerably since the last time I talked to you, Bob.
Yeah, definitely. And so, it's a much bigger project. This isn't, as being an entrepreneur, you try to, go to the market with a test case or whatever. If you're making pickles, you go make a batch of pickles and you go to the flea market and see how well they sell, and you come back and maybe make 2 batches next week or something like that. With this project, you got to set up the clearinghouse and the exchange and getting market makers all there and, all the traders there on day one. And it's a formidable challenge, but we think we're putting all the pieces together and we're really excited about where we're going. So I want to tell you more about crowdfunding and how we're going to finance that and kind of where we're going with that. But I would like, if it's okay with you, Mark, is to kind of turn it over to Don and let him explain a little bit more about the 4 instruments.
I will never say no to tossing it to Mr. Schlesinger. So, Mr. Don, sir, regale us, sir. Break down for those who are new, or maybe they remember the old Volex instruments. This is kind of a bit of a new flavor on that. Break it down for us, sir.
So we'll certainly start with that, and we kind of say that you don't tinker with something if you've got a good formula. And so what we're now calling real vol, we've got the real designation in front of each one of the 4 products at the moment. So real vol continues the tradition of the realized volatility instrument that some of our listeners may actually remember or be familiar with. And it's simply the alternative to VIX, which, of course, we know settles to a forecast of implied volatility, which is derived from options prices. We settle to a calculation of realized volatility, and specifically, real vol futures are going to settle to whatever appropriate real vol index, and we've got about 40 different ones. One of the beauties of this concept is that most listeners know that while VIX has been tremendously successful, it has been in a single product, that is on the S&P 500. And the reason for that is probably because you have to have very developed options suite of instruments in order to be able to calculate the VIX index at all times. And realized volatility is very different. You don't need any options at all. You're making a calculation based on a close to close of the underlying asset. And so all you have to have in order to be able to create a real vol index on which to base a real vol futures contract is simply a closing price every day that serves as a reference. And if you gather 21 of them, you can settle to historical or a realized volatility. So this is a really key metric to understanding and quantifying risk, and having the ability to trade risk or volatility itself kind of opens up a whole new frontier in being able to control and manage the systematic risk of a portfolio. So that's a quick overview of product number one. A second one that we're really excited about is a real day option. And this is simply a forward starting option, sometimes called a delayed strike option, but it lives for only a single day. It's a daily option. And it's kind of the logical continuation of the shortening of durations of options over the years. We went from listing them every 3 months, and then the next thing you know, you had monthlies, and then all of a sudden you had weeklies, and they garnered a tremendous percentage of the volume. The weeklies are wildly successful. But we're taking the concept to the next level, maybe what you might call the ultimate level, and that is a single day option, which would then allow the user to target any specific daily event. Obvious ones like an election, a Fed meeting, earnings announcements for underlying stocks come to mind, the end of quarters, anything in which you would like to target exposure for a single day. And so because they are single day options, what's kind of exciting for us is they're very cheap, obviously. You buy an at-the-money option that lives for only 24 hours and is struck the day before expiration day, depending on the underlying, of course, and volatility. These options can trade for considerably less than a dollar, 40, 50 cents. And so in terms of the exchange, we think that we can garner a great deal of volume with such a product simply because people are going to want a lot of them and they're going to trade them on a daily basis. So we think that this can be a very successful product.
Well, I definitely agree with you on that latter portion there, Don, because in the half decade or so since you guys have been on VolViews, a lot has changed in the world of options, including just about everyone seemingly has flocked into shorter duration contracts. The weeklies have exploded over that time period. Look at any large equity index in particular, and most of the paper, and a lot of the individual names as well, has flocked into the weekly contracts. Of course, we've seen even CME launching micro futures recently. That's the most successful product in the history of that exchange there. So it does seem like in the intervening half decade or so since you guys have been on VolViews, that short duration has exploded. So you guys are definitely in the right wheelhouse with that consideration there, Don.
Well, I'm glad to hear that you concur, and it's important to get the support of the industry experts. But yes, personally, I'm really very excited about Real Day. One that I'll pass over a little bit more quickly is Real Globe, and that's because while this is a tremendously ambitious product that has the potential to kind of revolutionize the whole concept of international and global trading. It's somewhat on the back burner for the moment, but the idea is to list country index futures and options on one single exchange, but trading those futures and options for exchanges all over the world. And the cost savings could be dramatic from such a concept, as well as the capital efficiencies, if you will, of centralizing such an endeavor. So we expect to compete with the listing of worldwide index futures with trade on local exchanges, but with a truly global marketplace and liquidity. So this is something that we are excited about, and we think that it can not only revolutionize the way people trade internationally and gain exposure to currencies and stock markets all over the world, but it can do so with a dramatic savings in terms of efficiency. So that's Real Globe. And of course, we circle back to what kind of started it all. Real Limit is both a concept and a product. So Bob discussed the concept, which was you could apply a fully collateralized idea to any product. So you can have the limit concept or the real limit concept and apply it to Real Vol, or apply it to Real Day, or apply it to Real Globe. So the first thing about Real Limit is that it's a concept. But the second thing is that it itself is a product, because we intend to launch Real Limit futures. And so, for example, if you had an S&P product or a major equity index, the idea would be that you could now trade not an option, which we know if you buy it has limited risk, but now a futures contract, which to our knowledge has never existed on any exchange with limited risk, but which now would permit the investor or the trader to define upfront what his appetite is for maximum loss or maximum gain, post that amount of collateral, and know that there will be stops both up and down to what a total loss could be on a daily basis. So that's the Real Limit concept, but actually applied to a straight line product, a futures product, and something that we think can gain a lot of traction that, to our knowledge, has never been tried before.
Well, to my knowledge as well there, Don, I've never heard of anyone trying a product of this scope, let alone all four of these iterations simultaneously. You have the products, you have the exchanges, you have the clearing, you have all of these other moving parts. It certainly is ambitious, and it sounds, I know, for a lot of our listeners who've been looking for something a little bit beyond what's been offered in the traditional volatility and now, indeed, in the traditional exchange space. It sounds like you guys are aiming squarely at them. So, Bob, there's a lot of moving parts here. Where do we stand? How is this process coming along, and where are we in the process right now, sir?
All right. Well, let's tell your listeners that we are raising capital. We can say that because we have applied for our crowdfunding, essentially a Reg D offering. A Reg CF offering. Reg CF is a special offering that was, I guess, born from the Jobs Act, which President Obama kind of signed several years ago. And it allows, the current iteration is that it allows for up to $1 million. Actually, it's, I don't know if it's indexed for inflation. It's actually a little more than that, but up to $1 million from non-accredited investors. And before that, you essentially had to go to rich people, accredited investors, to get your money, to launch an endeavor, like Shark Tank or something like that, right? You had to pitch only accredited investors with large amounts of risk capital, and you had to know them first. And so you really couldn't market your product. And so Reg CF allowed us to do that. So we're very excited about that. So now we have a crowdfunding portal called netcapital.com. And on there, you can, search for demand derivatives, and our whole offering is out there. The offering statements and the pitch videos and, summaries of how it all is going to work. But I'll go through that quickly now. So I can't talk to you about how wonderful this is going to be, or how much money we can make. That's not allowed by SEC rules. But we can tell you where we're trying to go and where we've been, right? So where we've been is to create all of these different instruments, put all these pieces together figure out a way that we can clear. Oh, if we need to clear, well, how are we going to clear? We need a limited risk contract because there's no way we could raise $1 billion or more to start a clearinghouse. So that's kind of the impetus for how Real Limit was created. So we had to solve all these pieces of the puzzle. And we are now in a really good place. We have, attorneys ready to go. We have the instruments designed and patents filed. The crowdfunding thing is all set up. So what happens? So we need a certain amount of money. It's actually, I can't tell you that either. According to the crowdfunding thing, that's one of the terms. But you can go onto the crowdfunding platform and it'll tell you, what the limits are. And the reason that I can't say $1 million, because, that's the limit, right, is because we're doing a side-by-side offering, and that goes into a different regulation, and that is more. So what we're trying to do is finance the whole thing, and that amount of money that you'll see on the website will get us to launch. There are 4 key areas that we need the money for, and that is to obviously pre-marketing, but before we get there, we have to file and get our futures license, right, with this Commodity Futures Trading Commission. It's called a designated contract market and a designated clearing organization. So we need to get those licenses. We have attorneys ready to file the papers on that. We just need to be able to pay them. We need our other attorneys to file for our patents, protect our IP around the world. They have been filed, but this patent process is a process. It isn't just, okay, you're filed and you're done. You file in the U.S., then you submit papers for international, and then, it's a whole big thing. And we're in the process, and we have time, but we need to get on that. And we can then proliferate and protect our patents around the world. And then we need to install the technology. We have the technology all ready to go. The systems are part of a company called GMEX. GMEX that is in London. They have several successful installations around the world. In fact, they just started their own exchange. Typically, they just kind of piggybacked or partnered with other exchanges that were launching, but now they have their own exchange in the Seychelles, in Mauritius, off of the coast of Africa. And it's a securities exchange and a derivatives exchange and a commodities exchange. They basically applied for everything. They're trying to get a banking license and a broker-dealer license. I mean, they're really going all out. And the Seychelles is kind of like the new, Cayman Islands or Bermuda or something like that, as an offshore financial destination. So the point is that the technology is all ready to go. They have not only the exchange technology and systems, but the clearing as well. And we're doing blockchain clearing, which is, it's kind of like a tiptoe blockchain clearing or a light version of blockchain clearing. And what I mean by that is a blockchain is defined as a distributed ledger. We're not distributing it, so it's really just a ledger. But that offers us some very interesting benefits. One is that we can use the format and technology of the blockchain, an immutable record of trades, and that will make regulators, more happy and more appreciative that we can't go back and, essentially fiddle with the numbers or change trades or anything like that. It's all hard-coded, basically. And it can be updated instantly since we're not distributing it. So that's a big thing. And it really can't be hacked because it's going to be a standalone kind of system. So there are many benefits to doing it that way. And another benefit is in the future, if we ever decide to distribute it, we don't have to revamp the whole clearinghouse structure. We can just start distributing it. So that's the process we're going to use. And the beauty of it is that you can open an account directly with the exchange. You can still go through your broker, we're hoping, but you can open an account directly with the exchange. All of that money will be held with the federal government via the U.S. Bank and their U.S. government money market fund. This was one of the funds that CME uses as valid collateral. Your money will be safe and there and fully collateralized. So what I would like to do is actually throw it back to Don just for an example. I think what would be really helpful is if Don went through an example of the real limit concept and, for people to really get a handle on that. If you have time, Mark.
Like I said, I'll never hold back from tossing to Mr. Schlesinger. How about you?
Okay, so that's that, and we can. But as far as the exchange, we are trying to raise what we need to get to launch, and then we're going for round B, which will take us through to sustainability. So we're going to go through 2 rounds. One here, the crowdfunding, which will get us to launch, and then the second round, which should take us to sustainability. Pay for the operations, pay for the marketing to ramp up, and get to a point where we can actually make enough money to keep the exchange going. The mantra of the exchange is we're trying to save the clients or the traders at least 50%. So we're actually, like Don was saying about Real Globe, that it's a very cost-effective solution. That's before the fees part. We think we can save customers at least 90% in transaction costs trading international equity indices with the Real Globe product, and that's before we get to the fees. And so, if we just charge the same fees, let's say, as the CME, you're still going to save, on the order of 90% trading with the Real Globe concept. So there's the total cost of trading, how many transactions, how many contracts do you need, how often are you rolling, like all of those things, right? We've cut out a lot of that kind of, ancillary transactional costs, and then we started working on the fees themselves. So if you're just looking at one trade, we should be able to save you somewhere between 50 and 90% on the trade. If you're looking at sort of a portfolio, what are my costs of derivatives? We're in the 95, 97% kind of range of cost savings, which I don't think another exchange could touch us.
Well, Mr. Schlesinger, you have been invoked, sir. Let's run through a quick example, and then we'll talk about where folks can go to get access to all this fun stuff. And I know we can't wrap up. My audience would get mad at me if I didn't at least pick your brain about the current vol space as well. So let's do that in order. First, sir, break down some of the real limit. Then we'll break down people can get access to this for themselves.
So the concept is really a very simple one, and that is supposing you come in and you've got an index with a futures contract that's trading and it's priced at 1,000. The trader can come in and place an order to buy or sell, obviously, as many contracts as he or she pleases. But then the novel concept is that you decide to post a certain amount of margin. Let's say it's $3,000, and let's say that there's a $100 multiplier on the contract. So that would basically mean 30 points up or down. So you now have this particular futures contract, but you have limits. You've got a maximum loss if you bought the contract of 30 points down from 1,000. So let's say 970. And you also have a cap on the gain, which would be 30 points up or 1,030. So it's a range of 60 points. And of course, these margin limits will be commensurate and set by the exchange depending on the actual volatility of the underlying contract. You want to set limits that are realistic and that allow enough room to let the contract run, obviously. And you've got different volatilities for, the euro than you might have for crude oil. So those will be proportional and commensurate with the actual volatility historically long-term of the underlying asset. So now there are lots of different scenarios, and we certainly won't go over all of them. But now, you've got this contract, and it trades during the course of the day. Perhaps it never touches either one of the limits, and it trades like any traditional futures contract. Perhaps you do get stopped out above or below, and if that's the case, then the contract is immediately cash settled. You are out of it for that particular day, and you basically have either made your 30 points, lost your 30 points, and obviously the counterparty the same on the other side. Question then comes as to, with traditional futures contracts, you can continue in them. You don't necessarily have to have it closed out on a day-to-day basis. These contracts are going to settle at the conclusion of each day if they're still open, and that is that you haven't decided to either trade out of it as you would any futures contract for not having hit the limit, or you hit the limit during the course of the day and you were stopped out either above or below. Now, let's say you want to continue to the next day, have another contract. You can simply state that you want to continue and therefore be put into another contract for the next day with a new settlement price, a new centering of your margin limits, and you get to choose if you want to change your margin. Or maybe you don't want to risk 3,000 tomorrow. Maybe you want to risk only 1,000 or 2,000. We have also been playing around with the notion of asymmetrical limits, which would mean that your upside doesn't necessarily have to be the same as your downside. You may want to limit your losses, but you may want to let your profits run and go twice as much in terms of the margin for the counterparty. So you would post, let's say, 3,000 to the downside, but maybe you state that you want to have 6,000 as the upside limit. So there's a great deal of flexibility within the actual tinkering with the collateral that's posted and how this will continue from one day to the other. We also have something I'd urge listeners to take a look on our website. We probably don't have time right now, but we do have a wonderful notion that we've called PEAS, P-E-A-S, Perfect Execution at Settlement, that will allow people to hold these contracts and without incurring any bid-offer spread, be able to be taken out at the end of the day at the exact settlement price, which is a wonderful feature that often traders aspire to, but is difficult to obtain on or to guarantee on a regular exchange. So that's a quick overview of the product and how it may work. Again, if you go to our website, demandderivatives.com, we have brochures on all of these products and actually videos as well. So I'd urge listeners to head on over there and have a look.
Don just said it. Demandderivatives.com is the place to go if you want to kick the tires. And I'm pleased to say you can also go there and click on the crowdfunding portal. And if you want to get a piece of this for yourself or just learn more about the process and how it works, you can find all that as well. Bob, really quickly, break it down for us, sir. What can they find on the website, and what can they find if they click through to the crowdfunding portal? How does all that work?
So the website, as Don was saying, we have pretty much videos and brochures. So whether you like it written or just like to sit and watch on each product, on the exchange itself, and then it kind of just outlines, what are the benefits and the drawbacks of this approach. And so, the website is a pretty good spot for that kind of thing. We also kind of list, some of our team members and like partners, that kind of team member, and some of the testimonials, et cetera. But there's a crowdfunding link, and if you click on that, it sends you to the Net Capital portal. If you're familiar with crowdfunding, you know that you have to go to a third-party portal. These are FINRA-registered entities that, they collect the money from the investor. They make sure that you get your shares. They also perform, the Know Your Customer and KYC, AML checks on the investor, but they also do it on us. So they do background checks on the managers and kind of go through a due diligence on us. So they, as the portal company, they have, a pretty solid, checklist of things that need to be done for you to crowdfund. So this isn't just us, putting on our website, hey, send us, $100 or whatever. This is a whole big process with an escrow agent or a transfer agent for the shares and all kinds of things. So it's actually like a quasi. By the way, it's a quasi public listing in a way, because it's possible after you buy a crowdfund share, after a year of holding the period, you can start listing them on the same portal, on the Net Capital portal, selling them for sale. So this is one way you can get liquidity in your private equity investment. And so it's actually a pretty interesting, process. And we really wanted to kind of democratize this whole thing. We could get, investment banks and hedge funds and essentially rich people to go and fund this exchange. But we really, really wanted to get some, offer it to, let's say, the regular trader. So the minimums are low. I can't say what they are. Again, that's one of the terms that the SEC doesn't allow me to say, but the minimums are low. It's a way to invest in the exchange. Wouldn't it have been great to own the New York Stock Exchange or the CME from inception? So this is your chance to get a new exchange, right from the beginning.
Well, Bob, you can't say it, but there's no reason I can't. So head on over to Demand Derivatives. That'll give you the full overview. Then, of course, click on the crowdfunding portal there. The minimum is $105. That's it, listeners. And the share price is $15. So even if you want to just dip your toes in, you can do that. And, of course, if you want to dive deeper, there's a lot of information there as well. And, of course, you can reach out to Bob and Don. I'm sure they'll be happy to chat with you. I've been very happy to chat with both of you guys as well. It has been too long. I'm very pleased to see that you guys are still actively fighting the good fight, not just on the realized vol front, but now on the exchange and the clearing front. And you know what? Before we go, I'd be remiss, because I know a lot of our longtime listeners of Volatility Views are shouting into their podcast devices right now. We are in a bit of a rarefied volatility regime right now, where maybe we're coming off the heels of one. Don, you are famous, nay infamous, as the king of short volatility. One of your favorite sayings, I still use it on the network once or twice a month, is options should be sold or not sold, never bought. So I also like iron condors or an iron butterfly for cowards. I use that one once or twice too. So I've purloined a few of your sayings along the way. But people are dying to know, Don, what are your thoughts on the levels of vol we just witnessed and perhaps the volatility we're going to see going forward?
Well, first I'll just make a very quick correction to the quote that famous or infamous, and that is, there are really only two things you ever should do with an option: sell it or don't sell it. In any event, yes, look, this is unprecedented, and so we should have an unprecedented volatility regime to go along with what's happening worldwide. I think that VIX topped out at about 82 and change back in the middle of March. But what listeners may not know is that realized volatility was actually even higher than that. I'm not sure that we hit 100, but we were definitely in the low 90s. And so even back to 2008 and Lehman Brothers and what have you, that practically topped out at the highest reading for 21-day historical volatility that we have ever seen. And naturally, you have to realize that there's nowhere to go from that but down. And so that's what has been occurring ever since. And we kind of see a mirroring of the inverse of the S&P itself. I think one of the most interesting things you could do would be to take a graph of what the S&P 500 has done since end of February or so, flip it over upside down, or if in Excel you can take the negative of every one of the points, superimpose it over VIX or over realized volatility, and you'd be practically looking at identical graphs. So in terms of anything having to do with future volatility, be it realized or implied, I think, as always, I'm a believer in you have to have a reference point, and that is the underlying index, and you have to have a viewpoint as to what's going to happen from here. We've just had a spectacular rally, and there are some people who think it will continue, and there are the naysayers who say that, you know, we're far from out of the woods, and we could, heaven forbid, test some of the lows that we saw back, you know, in the middle of March. Were that to happen, to me, it would be absolutely axiomatic that volatility would then explode again. So you take your cue, however you may feel, from the underlying index itself. And if you think we're out of the woods, and if you think that all is well or is getting well, then you're going to see volatility continue to revert to the mean, which is a heck of a lot less than the 30 or so that we've been seeing lately.
Oh, Don, one thing you said, I think you misspoke, but just clarify. So when you were talking about the inverse chart, so you said, that volatility would be the inverse, whether it was implied or realized kind of thing. Is that exactly what you meant? Because, generally realized vol has, or let's start with VIX. VIX has about a, 75, 80% negative correlation to the market. When the market goes up, volatility goes down, or vice versa, right? But realized vol has almost no correlation to the underlying market in the long term. So can you explain what you meant there?
Well, no, it certainly would be a lot more the inverse if you did it against VIX. So if you took a look at the VIX graph and you took a look at the actual inverse of the S&P, I think that you'd find a spectacular negative correlation. If you did it with realized volatility, I think that you might find less of a correlation. But in these unusual times, I think that you would probably find a similar relationship to VIX, and that is that realized volatility spiked tremendously when the S&P dropped all the way to 2,200 and change, and realized has been abating, if you will, and coming down in a similar course that you see to VIX. So although normally speaking you don't get the negative correlation with realized that you do with VIX, in these times, I think you would probably see it with realized also.
Yeah, good.
Well, gentlemen, I'm very glad we can get you back on. Like I said before, I'm very happy to see that not only you continuing to fight the good fight on the realized vol front, but you have expanded the front to include clearing and exchanges and everything else. Check it out for yourselves, listeners. DemandDerivatives.com is the place to go. Gentlemen, I wish you good luck in all the various endeavors, and I'll look forward to catching up with you again very soon.
Thanks, Mark.
Thank you.
And thank you for listening, and we'll see you back here on the network for more programs very soon and more episodes of Options Insider Radio coming at you next week.
You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.